Good day, my friends. This is the first instructional video of the Options Are Easy series. Today I want to tell you about the terminology of option trading. It's all kinda bookish stuff and I'm gonna do it in a very brief form, so that you have a basic understanding of options trading terminology. See, there are two types of options, the American type and the European type. The American type assumes the possibility of early expiration, early execution of the option, before the expiration date. European type, these are options that are expired on the day of expiration, at a given time. As a rule, the European type is often used, because the early expiration is not very interesting, because the time award is lost for those who apply for an early expiration. Next point, we have a wide spread of vanilla options on the classic exchanges, but there are also other types of options. Vanilla options are those types of options which have standardized contracts, which are used on derivative exchanges. There are also variants of barrier options, which are also called binary options, and they are used quite widely. And this is not very interesting for the client, because there are too many of those companies which are trying to sell binary short-term options to their clients, and they actually have a very high volatility, and they are very expensive. The trick is that the customer simply cannot calculate these options correctly and overpay for them too much. The bottom line is that the house that offers these binary options makes money. There's nothing to care about here. It's not the option themselves that are at fault, they're just not used quite correctly. There's also such type of options, the so-called flex options. These are options from a variety of conditions, which are used mainly for hedging in complex over-the-exchange market options transactions. Next, I want to focus on another options. These are deliverable and non-deliverable options, because any option trades on a particular underlying basic asset, which can be a stock, or future, or an index perhaps. There are also such options. Accordingly, we have options which are either deliverable or non-deliverable. As a rule, at the classic derivative exchanges, the trade is carried out with call options, i.e. after expiration and execution of your option, you receive the underlying basic asset, which is either a future or stock, or a future on a commodity, for example, oil, gas or copper, and so on. On some exchanges there are non-deliverable options, that is, just billing options, which severely limit option strategies by the fact that you do not get the underlying basic asset. You can't wait for the according period of time. You don't have so-called collapse in case you use some synthetic. If you overbid, that synthetic collapses over that expiration. In the case of non-deliverable build options, such strategy is impossible. It doesn't work. And I think it is a very significant limitation, like some kind of hacked options. Next, it's the strike price. The strike price is the price of the option execution. Strike prices are usually depicted by pips or points. Accordingly, at the strike price on the expiration date, the option is carried out. The delivery of the future happened, for example. Of course, you have to understand that options are only exercised if the options are in the money. If the option is not in the money, there is no exercise on it. It's just closed by a deal at zero price, a reverse cross deal. Next is the expiration date. Generally, derivative exchanges are using options with weekly expiration dates. That's when a week before expiration is due. Also monthly and quarterly expiration dates. Quarterly months for futures and options coincide. Quarterly months for futures and options coincide. That is, the expiry date of the underlying basic asset in the futures can coincide. In this case, the quarterly months are classic: September, December, March, and June. It's clear that weekly options are the shortest, but there are also day options, ultra short, so to speak. The most common and most popular are weekly and monthly options, but it's clear that quarterly options will become weekly options a week before expiration. That's how the expiration dates are ranked. In any case, on vanilla stock option, you can lock in a profit at any time before the expiration date is due, simply by making an offset trade. If you have bought an option, you sell it, short position, you have closed the long position. If you sold an option, you exercise it, and by closing the position, you lock in profit or loss you made on that option, so you don't have to wait for it to expire. What I also want to point out is this. These are the basic types of options. The call option is for buying, and the put option is for selling. That is, for the call option, we get the underlying basic asset at the strike price. Here, take a look at it. And on the put option. Now, give me a second. A purchased option, for example. Here you see the put option is bought, and we get short. This is the base asset at strike price. That is a short sale of the underlying basic asset. Accordingly, in case we bought a put option, we have the right to get a short position on our option on the underlying basic asset. In this case, Bitcoin futures. At strike, in our case, at 27,000. If we have a call option, then we get the right to receive the futures on the expiration date at 32, regardless of what the price will be. Option buyers have a right and option sellers have an obligation. In this case, if you sold an option, it looks like this. Sold put options. Accordingly, we have an obligation to sell it to the buyer. That is, to put a short position at the strike price. And in this case, we have a long position in the futures. Call options will look the other way around. It's very simple. In the next video, we will touch on the math of options. And to reinforce this material in your head, you can open the terminal of the ae.exchange and try to see if you can construct an option bought or sold, call or put, and find out for yourself what you will get on the expiration date for your options, what the position of the underlying basic asset will be. If you liked this video, give me some likes, ask me questions. I will try to break down all the basic positions related to option trading in the next video of the Options Are Simple course. Thank you for your attention. Have a successful options trading.